Welcome to Massive Passive Cashflow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
All right. Hello. Welcome to Real Estate Investing for Professional Men and Women. Podcast for you and me. If you're probably a professional. You're probably an engineer, a dentist, a pilot, teacher, or better yet, even business owners. We got a lot of business owners following this podcast here. And if you have not subscribed yet, please feel free to do so. It's on 30 different channels now, iTunes, iHeartRadio, Stitcher, you name it. And also, more importantly, go to realestateWithGaryWilson.com. If you're already a member, you know what to do. You click on the button on the left. If you're not, and you want to check this community out, click on the button on the right. That's all you do. You get a free look for 30 days. You get to meet everybody that's out there that we've trained. So guys, we've trained over 3,000 agents to work with us investors. They're certified investor agents. You got to look for that certification, certified investor agent. The only way to get that is through us. We're all investors. I'm an investor too, just like you. So we train them to work with us. It's an invaluable resource. And you might as well check it out because it's free for 30 days. So do that. And then in the meantime, let's go ahead and get hopping on this podcast here. So we got a great guest from the great state of Hawaii. So Lane, welcome over. We got Lane Kawaoka here. He's an investor and also an engineer. So Lane, if you would mind, first off, thank you for being here. I appreciate you taking your valuable time to share your knowledge and suggestions with our followers.
Yeah, thanks for having me and see how we can help out the folks best we can in a short period of time.
Well, I'll tell you what, if you wouldn't start, right away, I think people are intrigued. You've got a lot of units, you're in Hawaii, and you're an engineer. So if you wouldn't mind, maybe expand a little bit, just give people some background, like how you actually got started. I'm sure you went to school to become an engineer, but did you get started while you were in college? Did you buy your first property right out of college? Kind of tell us about that, and then we'll move forward from there, maybe do some case studies.
Yeah, so I got started in 2009, bought my first rental up in Seattle. But, probably like a lot of people listening, I kind of grew up in a middle-class family where you're kind of programmed from the get-go to go to school, study hard. I guess I was good at math and science in elementary school and high school, so I became an engineer, went through college. Started out as you were a computer science guy. I was more of a civil engineer type. So first job we get is get out in the field and, watch concrete cure and watch staff do, manual labor out there. It's not fun. Yeah. So I was pretty frugal back then too, still am. So I just saved my money and bought a house to live in up in Seattle, which, we're all kind of programmed to think that, a house is investment, which I don't really quite believe these days.
Yeah.
But, I call it the linear path, right? We're all kind of programmed to kind of blindly follow this financial blueprint.
Yeah. Yeah. I'll tell you what, you hit on a couple of key points there. Number one is when you bought that property, it was 2009, which is pretty much, the market had just literally tanked and it started leveling off at the bottom around 2009. So in that time frame, what was interesting is more wealth changed hands in those years than any other time in history. Now we're in another time in history. Here it is 10, 11 years later, where it's likely to happen again. But back then, did you know that did you recognize that you were really getting in one of the best times ever? Or was it more just like a one-time event, like maybe you hadn't transitioned yet from linear thinking to exponential thinking? But what was your mindset back then? Did you recognize that was probably one of the best things you've ever done or getting ready to do?
Not really. I was trading stocks at the time, and I kind of knew it was sort of big. Everybody was freaked out about it. But, as far as I was concerned, it was just I was saving up $80,000 to buy a $350,000 house. Yeah. And that was the place I was going to live in. But because I was living on the road a lot, in fact, I was never home. I was only home on Saturdays. Young single guy in my 20s, I decided to rent it out, and I think my rents were like $2,200 a month, so not quite the 1% rent to value ratio.
Yeah.
But I still made a few $100 of cash flow, and for a young 20-year-old kid, that was a lot of beer money. And I was like, shoot, I got to keep doing this again and again. So in a couple of other years later, I saved up to buy more of a B-class rental in Seattle, $250,000 purchase price, and I think I rented for like $2,000 a month. Still not the 1% rent to ratio, but
Right.
I was kind of educating myself, reading all the books. Millionaire Real Estate Investor by Gary Keller.
Yeah.
Was a big one. All the podcasts out there, and I, started to adopt this mindset of the 1% rent to value ratio, and buying in more B and C class markets where, the numbers made sense.
Yeah, it's true. And what's funny is the grades A, B, C, and all that really means something different in different markets. Like a C property in Seattle, might be $350,000, but in Macon, Georgia, it'd be $80,000, right? It was really interesting if you really study the data. Like, I'm a huge proponent of gathering data first before I take action and make decisions. Is when I started looking at the rents to cost basis ratios, I recognized there were clearly markets that were better for flipping and clearly markets that were better for buying and holding the rental properties. But the bottom line is this: when you buy right, like one of my great teachers, Robert Kiyosaki, and got to spend a day with him, had dinner with him. After I studied him back in the 90s, and then 5 years ago he came to our mastermind group in Lake Tahoe, spent the day with us, had dinner and all that, and a real neat guy. And he emphasized that. He said, look, a lot of people go in and start off buying the really cheap, crappy stuff because it's cheap, and their rents are relatively better relative to the cost basis. But he said, so they have higher cap rates, but it also means higher risk, right? And he said, if you actually buy the better properties, they'll not only have less deferred maintenance, you have better tenants, the rents increases are more dramatic, and over time, your wealth, your equity and cash flow grow more. Now, having said that, I will tell you, he also has a marketplace, and I do too, for the subsidized renters. So you can buy big apartment complexes and get a nice Freddie Mac loan for it with a long fixed rate term, as long as you make a certain percentage available to subsidized tenants. And in an economy like right now we're heading into with this new recession, those are going to be the hedges, right? Those rents will be paid. So it's the lower end properties, they won't ever appreciate as much, but they'll hold the value and you've got income coming in. So different markets mean geographic markets, and different markets mean where you are in the economy, So relative to that, in fact, have you noticed, like, since 2009 to here we are 2020, we've been down, we've been up, and we're heading back down again. Have you changed your strategy, or talk about strategy, and what did you do? Did you do anything differently in the last recession, the bottom of the recession, than you did, say, like in 2015, 2016? Or maybe you're thinking a different strategy now. So if you don't mind, talk about that a little bit, Lane. That'd be awesome,
Yeah, I mean, so this is, back in 2012, the prices were going up in Seattle. I was not able to cash flow anymore. So I bought a property. They call these turnkey rentals. So these house flippers will pick up a property, they'll rehab it, they'll rehab all the major components like new flooring, new paint, new HVAC, appliances, etc. Even sometimes put a brand new roof in it, and sometimes even put a tenant in there for you. So I dabbled in that. I bought one in Birmingham and it worked. And I sold those 2 Seattle properties, did a 1031 exchange. And in 2014-15, I had about 11 of these single family home rentals.
Nice.
In Birmingham, Atlanta, Indianapolis. And my strategy, even from the get-go, was cash flow, right? I mean, appreciation. I definitely got fortunate on appreciation, but to me, appreciation is icing on top of the cake. It's because I realized pretty early, as a working professional, as an engineer, I was going to have to keep working that job, but it was the cash flow that was good from the properties that was going to make me able to quit my job one of these days. And eventually did that. So that was kind of the strategy from the get-go. Just pick up properties that cash flowed. And a lot of these turnkey rentals you can get for about $100,000 with a $20,000 down payment. The monthly rents are $1,000. So by the time you pay off your repairs, your other expenses, have some vacancy, maybe put some money away for CapEx and pay a property manager, because we're not landlords here. We're investors. We pay people to do that dirty work for us, especially when you're doing it remotely.
Yep.
So that cash flow kind of accumulates over the properties, and every property is maybe a few $100 on that smaller scale.
Yeah.
So it takes a lot of properties.
Yeah. It's funny you mentioned Birmingham. I just taught 2 classes there last week. Was that last week? Last week, 2 classes, not in person. Now it was all online. But they just ate it up because Birmingham has been a great market for a long time. And the funny thing is you mentioned some great markets, and I want to emphasize this to people is, some markets are tier 1, like based on MSA, population, New York, LA, Chicago, Houston. Some are tier 2, like Indianapolis, for example, Birmingham. Then you have the tertiary markets, tier 3. So outside of Indianapolis, you've got Lafayette, Indiana, great college town. You've got Fort Wayne, Indiana, and both are just a couple hours from Indianapolis. And the pricing model is even lower there, but because of the economies, they have very favorable rents to cost basis, and they're college towns. I mean, you can't go wrong. So I learned if I focused on those tertiary markets, it was less competition, it was just easier to get the deals, Well, how about this? So you're in Hawaii now. Obviously, a lot of your business is you're investing remotely out of state. So I want to talk about that strategy a little bit. So I know, like for me personally, years ago, I wouldn't let myself do that, Lane. I was too conservative. I wanted to see it, touch it, feel it in my own marketplace. But now I got all these agents I've trained all over the U.S. and Canada, and I just literally go on my website, pick one, right? And I know them because I've trained them. And I look for the ones that are investing themselves, so I know they're not only helping investors, they're actively investing themselves. And I line up with them, and I don't have to be there. There's properties I haven't seen for years. There's properties I've never seen, quite frankly, and that freaks people out. But I grew into that. So what's been your experience with that? Did that come to you naturally, or was it more out of necessity? Or and how did you network to find the people that could go and actually, look at the properties for you and do all that legwork,
Yeah, I just got lucky because I hit this wall pretty early back in 2012. I realized that where I live, Seattle, wasn't a great place to invest. Great place for appreciation, but that just wasn't my strategy, right? And, as you were saying, tier 1, tier 2, I call those primary markets and secondary markets. So primary markets are all the sexy places to live, like Seattle, pretty much all of California, Hawaii, New York, Boston, places like that. Yeah. And you're right, I invest in secondary and tertiary markets with robust economies. So, secondary markets, just to name a few: Memphis, Tampa, Jacksonville, Kansas City, St. Louis, Birmingham, Atlanta, places like that. Partially it's because, when I was in Seattle, one of the things that I can point to that really kind of made me move this direction is I went to, Seattle has a lot of money, and I went to one of these events, one of these nights where they would, buy auctions, and it was kind of a war room style. And I looked around the room, and it was just a bunch of older guys from Microsoft who didn't know anything about real estate investing. And I realized there was a lot of dumb money chasing these properties. So why do you go to secondary and tertiary markets? Well, the pricing's better. Partially, like you said, it's just lack of competition. People are less inclined. People are scared. When people are scared, there's less competition. So it makes things a little bit easier for us to get. So, my whole thing is live where you want. I live in Hawaii. You can't cash flow anything out here, but you invest where the numbers make sense.
Yeah.
And a lot of my clients, they're professionals in California. There's no way you're going to cash flow in California unless you go to a class D or C area. Yeah. You don't want to do that.
Yeah. There's California's interest. I spend every other winter out there, usually 5 or 6 months. And obviously, 10 million people in LA County alone. But what's interesting is the rest of the state is actually not at all like LA. It's crazy. And if you go up in the Central Valley, you've got those towns like Palmdale, Bakersfield,
Fresno,
Modesto, way up north there. And a lot of people in San Francisco will invest in Modesto and Stockton and Fresno and all that. But Bakersfield is its own little world, and a lot of people don't pay attention to it. And a little town called Palmdale just landed a huge contract with a major, airline builder, airplane building company. I probably should mention her name, but in any case, it's a fast growing market. A little town called San Pedro down near Long Beach. Nobody pays attention to it, and it's dramatically improving. It's just crazy. But you're right. You've got to really, in California, you've got to really dig deep and search and get away from the big name areas, because the big name areas, I know people are investing there, but they're usually paying all cash or a lot of cash, and their strategy is more appreciation and just park their money. But if you're looking for cash flow, you've got to go for those smaller towns and tertiary towns. But hey, when it comes to cash flow now, as far as you purchasing, what's your favorite strategy for financing? Are you using traditional, big bank money, just get a commercial mortgage, put down your 20% and do that? Or do you ever do any partnerships, joint ventures, things like that? Like what type of strategies are you seeing that seems to work well for you, particularly like in today's kind of market,
Yeah, I mean, when I was buying single-family homes, it was all about just using the Fannie Mae, Freddie Mac debt. I make it pretty clear on my website and my podcasts that, look, I mean, we're real estate investors. You need money to invest. If you don't got money, this is not the channel for you, right? We're high-paid working professionals here.
Yeah.
And, I mean, that's just what I did. I saved my money. Every property I bought, I used 20% down payment and had some cash reserves on the side. No tricks, no games, just that way. Today I'm buying, my apartment buildings with other people. We're syndicating private placements deals with these folks. So we raise the private equity and the rehab money, but we go in and get the Fannie Mae, Freddie Mac non-recourse debt on top of that.
Yeah, that's in fact, we were talking about Robert Kiyosaki earlier. That's what he did. He did a Freddie Mac. He would get a 40-year term, like 3%. And all he had to do was make sure 75% of the units were available to subsidize renters. I'm like, anybody can make money on those terms, And but that's what he would do, non-recourse. And so as I grew in my own portfolio, I started off with the little stuff, singles, duplexes, triplexes, fourplexes. Started moving my way up, and my first big property was a 70-unit apartment complex, and that was a pretty creative deal. But we went to a private bank that was actually owned by other real estate investors, and it was a regular bank loan, but because they understood investing, we were able to work in the rehab part. Like we did the Bird method: buy, remodel, rent, refinance. And they did the draw on putting in like the new parking lot, new boilers, all that stuff. And so we actually got more money back on the deal in the first year. We made all those massive changes. It was amazing. And then we restructured the loan at the same bank. We raised all the rents an average of $100 per unit right off the bat, and basically sold that thing and doubled our money. We literally made over $1 million just by doing that, and I would never been able to do that if I had started off just buying those little single family homes and duplexes. So if you wouldn't mind, talk about your path from where you were buying those first single family homes to where you are now doing the syndications. Like what type or size of property are you looking for now in your syndications, or even for you just personally,
Yeah, so this whole epiphany came about maybe around 2015 when I had 11 rentals. Cash flow is great. You get a few $100 a month on each property, but with 11 rentals, I had an eviction or two every year, some kind of bigger issue that happened, like a pipe broke and flood basement, or HVAC getting stolen, maybe like 3 or 4 times a year, which is no problem because the property manager takes care of all that business. But you're the asset manager, kind of keeping them accountable. And at 10 or 11 units, that's no problem. But if I need much more than $3,000 of cash flow a month, I need 10 grand plus. So that's 30, 40 properties or more. Quickly you realize that's not scalable. So this is where I kind of started to, this is the first time I kind of pulled out my wallet and joined other mastermind groups and kind of paid for educations. And what I found was this world of other higher paid professionals such as myself, other doctors, lawyers, engineers, and they were investing in these private placements, or I think people used to call these country club deals when people actually went to play golf back in the day. These are private placements pulled together, or syndications for short,
Yeah.
where one group will go and pull maybe a few $1 million together, go buy a 200-unit apartment building, and then also do the rehab, like you said, increase rents. Today, we'll do a lot of we'll kind of put lipstick on the pig on a property, maybe about $3,000 to $6,000 rehab per unit, which buys new flooring, new appliances, but we don't really get into major rehab. We're just looking to bump the rents up $50, $100 across the board.
Yeah.
But and that's what I realize is a lot of these more affluent investors, these accredited investors, are kind of just spreading around 50, 100 grand in dozens of deals, and they're not doing any of the work. They're completely passive investors, getting their share of the profits and the tax benefits, which actually are stronger in these because cost segregations are done to be able to pull out the bonus depreciation. Yeah,
no, I agree 100%. So we, first time I really got into the big world, actually was about 2009 through 11. So I started with a brokerage company, and I was starting to get approached by people on Wall Street, even big funds like, White Oak Financial, BlackRock Financial, even the number one tobacco commodities broker on the planet approached me. And we actually created our own closed-end mutual fund. And he raised all the funds from all the Wall Street guys. When you know it's bad when Wall Street guys are leaving Wall Street, right? So we took all that money, started buying portfolios, right? And I got all the commissions because I had the brokerage company that did all the transaction work. And then we would pay off the small investors. Anybody only put in like $10,000, we would sell some properties, just get rid of them, right? And then the big players, we will make them equity partners and also cash flow partners. We give them part of the cash flow, part of the equity growth, and then we've sold more, we would give them part of that. And but all the property management, I got all the money from that too, right? And in any case, it was just an amazing educational experience for me. We've since done some other. We helped another guy do what's called a REIT, R-E-I-T, Real Estate Investment Trust, which is essentially a mutual fund that eventually becomes closed. And they buy big complexes and they, get the rents up aggressively and then either refinance or sell. And that's the model. So we're essentially sometimes taking big buildings and flipping them, but instead of flipping a single family home, we're flipping a giant building, and the value is based on the increase in income production. So, and it's not that complex. I wouldn't suggest it for a brand new investor, but I'd say somebody who's invested like you did, you've got roughly close to a dozen properties. In your mind, would you agree it really wasn't that big of a leap? Like you could understand what was required. You obviously learned and understood what was required to do a syndication, but it wasn't as big a leap for you as maybe as it would have been back in 2009. Does that sound roughly like a true statement?
Yeah, I mean, some of the advantages of, when you go to that bigger scale is you're working with more professionals. The residential property managers are kind of sketchy in my opinion. Just a lot of them, that's the first job that they get in life. And, it's kind of a young man's job. But when you step up into the more commercial field, you're working with, legitimate professionals, and they have, great business processes. You're not working with Toolbox Tim to come fix this or that. You're working with ABC contracting firm, big companies, much more reliable. You might pay a little bit more, but hey, it's a commercial asset. It can absorb those costs.
Yeah. Well, I like the fact that you mentioned the word professional a couple of times, and that's kudos for doing that, by the way, because a lot of folks listening are professionals. They have advanced degrees, they're engineers that own their own consulting companies. Orthodontists own her own orthodontic practice. It's just, and a lot of pilots, airline pilots, because of their schedules, they have chunks of time that they can use to do something else on the side. And they oftentimes choose real estate as the thing to do. And they just have those minds. They understand. They're used to looking at like checklists and being able to make snap decisions based on limited time but data. And that's why I think they do so well. Engineers also always do well with this. But what could you tell somebody? Let's say somebody's maybe like a mini you. Somebody's coming along now. They've got their degree from college. They're engineer or accountant or something like that. And maybe they've been at it for 2 or 3 years, and they realize that them working for someone else is going to be a limited life, and they want to do something else, they want to start investing, is there something you can give them, or a suggestion, or a website, or a report, or a book, or how can people get together with you and learn from you? And also back to the question, what could you share with them as far as words of wisdom to make that first move?
Yeah. I mean, in terms of case studies, I mean, people coming into my community are either a higher paid younger guy, and for that guy, what I would suggest, and this is kind of what I started with back in 2009. I was able to put away 30 to 50 grand a year from my paycheck. I just tell them to save your money for now. And when you can, when you save up 20, 30 grand, go buy another single family home. Maybe you live in California, or a place where the rent to value ratios don't make sense. So you're going to have to buy a remote turnkey rental. For those people are about that I started back in 2016, because I was still doing that. I would say that's a pretty good first start. Just check out my podcast, simplepassivecashflow.com. Those are all free resources for you, getting started. But if your net worth is over $500,000, we were kind of talking about, we have a lot of dentists in our group. Maybe they're not to $500,000 net worth quite yet, but they make over a $200,000 salary. And this could be any professional. You might be better slated to just go straight to syndications or private placements. And at that point, it's more important to build your network of other affluent investors around you, because that's where you're going to find your deal flow. And at that point, you put your trust in the operators to professionally manage the asset for you. And you just kind of focus on your highest and best use. So, I mean, a lot of people in my mastermind, they find that their highest and best use is, unfortunately, they may not like it, but go back to their job and do another surgery, or go get the next promotion, because that's really their highest best use of their time, is at their day job.
Yeah, I agree. I tell you what, I appreciate you sharing that, because you and I are a lot alike in that. I used to do, back in the 80s, we had to do creative purchasing techniques because interest rates were 18%. It was crazy. But what happened is people started thinking, well, that's the only way to invest. No money down, owner financing, buying on terms, all that stuff. And no money down financing has its place. It's just not every place. And what I learned was, when I got on a cash basis, life was way easier, not because I was on a cash basis, but it's because cash is king in business. Always has been, always will. You get the best deals, you call the shots. Later on, like what we do now is we'll acquire the asset, and then we'll strategically refinance it later on, right? And it's but what I'm getting at is it puts you in control. So even if you start off with 20% down, that's what I tell my folks too, is don't string yourself out 100% financing. It's just, you don't have enough cash flow coming in. All you need is one bad month and you're done. So go in with some cash, get better rates and term on your loans. Start off with equity and good cash flow, and over time you'll see your growth projectile will go much further, much faster. And so I appreciate you mentioned that, because a lot of people, Lane, don't say that. A lot of people are trying to teach, do anything but use your own money, and I'm like, they're always going to be the person with no money, right? It's just too highly leveraged. So is there, I see you've got your simple passive cashflow.com back there /club. So do you have a podcast? How can people learn more about you and from you?
Yeah, I mean, I got my podcast. I've been podcasting since 2016. It's been sort of a follow my journey. Initially, it was all about single family homes and turnkey rentals. But then, as I said, I transitioned myself from going primarily into private placements in mobile home parks, apartment buildings, and then who knows what else, right? Oil and gas, life settlements. I think something I've picked up, I mean, I just try and kind of communicate what I'm learning from other higher end investors and seeing what the wealthy are doing. Infinite banking, what are you people doing for taxes and legal, right? I mean, I've kind of set up my irrevocable trust recently, which I think blows LLCs out of the water.
Yeah.
So I kind of run a community for high net worth investors so they don't have to leave their house in my mastermind, most of which are accredited investors.
Yeah.
So I have that community on the side, but I also put together apartment and mobile home park syndications for my group too.
Okay. Well, I tell you what, we're kind of running out of time here, but I just want to tell you, this has been one of my favorite podcasts. I mean, not just because we're fellow engineers and big investors, but the stuff that you shared it's just good old fashioned horse sense. I mean, it's back to the fundamentals, and it's the guy who masters the fundamentals is the guy that wins. The same thing, just like Michael Jordan basketball, Larry Bird in basketball, they'll tell you they succeeded because they practiced the fundamentals till the day they retired. And it just never fails. Simple ends up always being better than complex, and what you're doing is a great simple formula, and obviously it's working for you. So I think I speak for a lot of people when I say thanks for sharing your time and wisdom, and I'll look forward to having you on again sometime again soon. So
yeah, I think the thing that people don't realize is this world of investing is pretty simple, but you need money, right? The stuff that the affluent and wealthy investors are doing is there's defined best practices out there, but it's all this these complicated strategies where you don't have money, people are borrowing, buy, rent, rehab, all this stuff, wholesaling, tax lien stuff. I don't do any of that stuff. That's what you do when you don't have money, right? But when you're a high-paid working professional, to me, the operating procedure is go to your day job, make a whole bunch of money, and invest it the best tax advantage and time-efficient manner.
Yeah, I agree. Yep, that's what I'm all about now. I won't get into all my business structure, but I've got it structured so I actually learned and used the tax code, and I've got the right tax accountant, the right tax attorney help me understand and build it correctly. But the code is written to be used. It's not meant to try to trick the government. It's meant to how do you use it the way it's written. And there's lots of ways out there to make money, and only pay the taxes that you need to pay based on the structure you have. So, in any case, I tell you what, everybody listening, I hope you have an awesome day, and we'll look forward to the next week's podcast. Again, if you haven't checked out the members area, just go to realestatewithgarywilson.com, click on members area. Next page, you select left side if you're a member, right side if you're not. Check it out. Glad to have you on board. We're all professionals, we're business owners, and Lane's exactly the kind of person I like to talk to because that's exactly what we do. And also subscribe to the podcast and check out Lane too. So you guys take care of yourselves. God bless you and your families, and Lane, God bless you too.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.